Welcome to SB News Podcast. We look at the fundamental aspect of the economy and its impact on the Forex future and the stock market. Any opinions expressed here are for information purposes and must not be taken as investment advice. The Reserve Bank of Australia reached the decision to maintain the cash rate goal at 4.1% as well as the interest rate charged on exchange settlement balances at 4%. With this, RBA has opted to maintain its cash rate unchanged for a third consecutive month. The RBA's action today demonstrates its wait-and-see approach since, despite being high, global inflation is starting to fall in key economies. This is RBA's 12th hike since it started raising interest rates in May 2022. The RBA would like some time to evaluate the effects of the interest rate increase on the economy, thus the autopilot increase in interest rates may be coming to a halt for now. By the end of 2023, inflation is predicted to reach 3.23%. And the RBA still remained committed to growing GDP by 1.75% in the next 2 years. The Australian economy has been expanding below trend, and this is anticipated to last for some time. Growth in household consumption and housing investment remain low. And as China, one of Australia's major trading partners, struggles to grow its economy in the wake of slowing global demand, reaching GDP targets can be challenging for the Australian economy. Even though the interest rate is now stable, it is undeniable that additional increases will be required if inflation stays high. According to the latest U.S. Census Bureau, construction spending was slightly higher in June compared to May of 2023. The expected amount spent on construction in June 2023 was $1,938.4 billion, which was 0.5% more than the previously estimated amount of $1,929.6 billion in May. Despite the increase in spending, today's figure shows an eighth month of contraction in the economy after a 30-month period of expansion. The labor market remains unchanged as the number of job openings remains little altered from its last publication, even though hiring declines in the manufacturing and the finance sector. U.S. markets fell on Wednesday following the downgrade of U.S. debt from AAA rating to a AA+ by rating company Fitch. Fitch cited a steady deterioration in standards of governance as a major reason behind its decision for the downgrade. In recent years, politicians have struggled to come to a compromise in terms of spending and debt ceiling. This, along with the insurrection of January 6, were the major contributing factor to the downgrading of the U.S. debt. Until 2011, U.S. debt had carried a perfect credit rating since Moody's Investors Service first assigned the United States a AAA rating in 1917. The country's new Fitch rating puts it on par with Austria and Finland but below Switzerland and Germany. The level of crude inventory in U.S. declined on Wednesday's reporting. This caused the crude oil to soar in early trading. However, it gave up some of its earlier gain by the end of the trading session. The focus is now on OPEC that is expected to meet on Friday. Traders are awaiting a statement from Saudi since, earlier in the week, they decided to cut production through end of September. On Wednesday, New Zealand published its unemployment figures. Unemployment rose to 3.6% from 3.4% in its last print, even though average earnings, salary and wage rate increased by 4.3%, indicating companies' willingness to retain quality employees. Mixed data published today failed to suggest which direction the Reserve Bank would be leaning towards in terms of interest rate hike when they meet next. You are listening to SB News Podcast. Don't forget to subscribe, like and download our podcast. It helps us bring more contents like this to you. Fundamental analysis of economy for Forex, future and stock market.